Hi, Donna Phoebus with Integrity Accounting, back with you on our balance sheet module. In this final in this final segment of Module 9, we're going to talk about equity, which is the final portion of our balance sheet, which you'll find down at the bottom below total liabilities. So for this training, what we're going to talk about, I did go in and pulled up all of the accounts that were inactive, and I want to go back just real quick and review those. So inactive accounts, ones that didn't have any activity in them, won't show up in this particular software unless you specify for it to show up. So just as a quick reference, there's other things that will show up in your current assets, and that's employee advances, your vendor deposits. That would be something like maybe you had to put down $1,000 for something to hold it. So you don't really owe them that money because what you've purchased from them hasn't come in yet. So it's still your asset, right? So other things were work in process, like if you're having some land developed, work in process for construction. Not all contractors use those accounts, but that's where you would see those. Fixed assets kind of stayed the same. There wasn't any additions there. So you have in liabilities, we have a few other things, and I should have mentioned, but out of sight, out of mind, credit cards. Credit cards are also debts, and those you'll see right directly underneath your accounts payable. So if you have a business card, that's where you would show this as a credit card under AP. So remember we were talking about loans payable. So these ones all show as zeros, but this is where your loans payable are going to go. So loans payable are also known as, I call them notes payable. It's just an accounting term that I grew up learning, and some people have different terminology. Some systems call them different things, but when I say note payable, it means loans payable. And so this is where you would have your loans for if you owed somebody money. So let's say you owed Dale Olson here $50,000 because he loaned it to you to buy a piece of equipment. So your piece of equipment would go up here, and your loan to Dale would be showing here. Land development loan, you got a loan for that. Land acquisition loans, if you have a car and you're making a payment, that would also go here. You should have that current liability here, but in this example you can see that the truck loan is all being held on this line here. So other ones is going to be a construction loan. That's for you guys that are generals, that you go out and you buy land and you build a house and then you sell it. So that is where things like that would be, and then in your WIP accounts, which are here, right? So let's move into equity. And equity consists of a few different accounts. In this example, we've got common stock, which kind of goes along with S Corps and C Corps. Those are the ones that would have stocks or potentially stock options and different percentages of ownership type stuff. In this example, we're not going to discuss that, but this is where common stock would show up as a piece of your equity in the company. So members' contribution. Members' contribution is like if you're a single member LLC, you would see a member contribution line, and that is any monies that the owner puts into the business. So if you took 10 grand and you put it into the business, it's going to go into your cash account because you're putting the cash in the business, and then the other side of the entry is going to be a member contribution. And because you're inputting money into the business, you're contributing it, which means you're adding to the equity because it's increasing your assets. When your assets increase, the transaction increases your member contribution. Members draw is the exact opposite. This is when you're taking money out of the business. And I will caution you on that because a lot of the time, one of the big mistakes that I see often is contractors using their business as a bank. And they're not really following the numbers because they don't understand the numbers. They don't get this whole balance sheet. Maybe they never even looked at it. But what happens is you're taking money out of the bank and you're not tracking how much money you are taking out. And so what you'll see at the end of the year is retained earnings being a negative because you're taking more and not leaving anything in the business. And what happens is when you want to go borrow money from ABC, financial company, you won't be able to because the bank's going to ask you for this balance sheet. And what they look for is this number right here. How much equity do you have in your company? If this number isn't growing, you're not growing. If this number isn't growing, you are not creating a saleable company. You're not creating an investment for yourself. The whole object of the company is not just to, give yourself a paycheck. It's to grow something. It's to, just because you get a paycheck doesn't mean that you're successful. It means that you're operating a business, yes, but are you operating the business to turn a profit so that you can, build the company and build the assets and have something that's sellable when it's time for you to retire, or something that you can leave as a legacy to your kids, something that you can leave behind that is representative of all the hard work that you've put in for all of these years. So you're not really running a business unless you're building equity. We can talk about some of those other things in future modules. It's very important to make sure that you are building equity in your company and you're not taking all of the money out of the company. With S-Corps and whatnot, a lot of times it's different than it is with an LLC. With an S-Corp, you're doing a shareholder distribution, and that's basically takes the place of a member's draw. And what happens is when the IRS sees that, if you've taken more out in shareholder distributions than you have as an actual pay, that throws up a red flag. And the reason being is because distributions are taxed less, and so you have to be taking a reasonable compensation as an S-Corp, or you could get into trouble. So obviously there's always the luck of the draw of getting audited, and you want to be on the up and up. Otherwise you're going to have a big problem. Could cost you your business depending upon the tax repercussions of making that choice to not do it correctly. So I just caution you there. And then we have your retained earnings. We talked a little bit about that before. So your retained earnings is basically where everything closes out to. So at the end of every year, at the beginning of every new year, your income statement starts over and it's zero, right? So it's like a clean slate, you're starting over. But your balance sheet as a whole carries forward from year to year. So all of these accounts always stay put. They're always there, and they're always having a balance that carries forward. Whether it's negative or positive, it's there. So retained earnings is where that's tracked. So if you made money at the end of the year, say for instance this is going to flow into this number. It's going to be represented right here, and it's going to increase this number, not decrease it. If you show a net loss, it reduces your retained earnings. If you're showing that you took out a bunch of draws, it reduces your retained earnings. So this is an important number, and it's not an account that you want to use to make adjustments unless it's absolutely necessary because you're cleaning up an error or something like that. So that's your retained earnings. That's basically really what your equity comes down to. So your equity is your total liabilities plus your equity should equal this number right here. And that's where you balance out. So it's assets equals liabilities plus equity. So if you take this 194, let's just do it real quick together. If you take this 194, let me get it over here. Okay, 194, 131.87, and plus our 117. So total liabilities, okay, 117,194.87 is 311, 326.74. We're in balance, as we could already tell here, but that's where this number comes from on the bottom end of the balance sheet. So this number plus this number, which is total liabilities plus total equity, gives you total liabilities and equity equaled out to your total assets. So equity, it is fairly straightforward. It's going to get a little hairy the bigger you get because there's more moving parts and pieces, but in this example it's pretty straightforward and pretty basic. Again, any questions, we're always here to answer questions. Group sessions, one-on-one sessions, we will teach you what you need to know in order to use your balance sheet to the fullest extent possible so that you can really understand the financial health of your business to get the most profitability that you can and make those important business decisions with real-time numbers, accurate numbers, so that you know what steps to take and when to take them. So I appreciate you being here. This was Module 9. In the next module, we're going to be talking about controlling your cash flow and budgeting, which will all kind of plays in together. But I wanted you to understand how to use your balance sheet because it's super important if you want to grow that business and take it to the next level. So I will see you in the next section.